Welcome to Brick by Brick. Join me, Lauren Winnett, as I share my personal journey of building a thriving real estate and hard money lending business from the ground up. Along the way, we'll explore the strategies, challenges, and breakthroughs that come with growing wealth. Whether you're a seasoned investor or aspiring entrepreneur, or simply curious about the world of private lending and real estate, this podcast is packed with actionable insights, real-world stories, and mindset tips to help you build your own path to success brick by brick. Welcome to another episode of Brick by Brick. I'm your host, Lauren Winnett. Today, I'm joined by Hugh Massie, founder and executive chairman of DNA Behavior International and chairman of Behavioral Economics Institute. Hugh has built a global reputation for helping leaders, investors, and organizations make smart financial decisions by understanding their natural behavioral style. By blending behavioral science, technology, and finance, he's able to show how behavior truly makes money. Starting as a CPA and becoming the pioneer in behavioral economics and author of Leadership Behavior DNA, Hugh is here to talk about dreaming big, starting small, and finishing strong. Hugh, welcome to our podcast.
Yeah, great to be with you, Lauren.
So I briefly went over some of the many accolades that I found when I was researching for this show that you have. But can you just give us a little bit of overview about who Hugh is and kind of what drives him in the space of behavioral economics?
Yes, so I suppose the first thing is just to deal with my accent, because I live in Atlanta, but everyone will probably tell that I haven't got an Atlantan or a Southern American accent. I come from Sydney, Australia, and that is where I started my career. And as you said, Lauren, originally as a CPA, and I suppose today I look at myself as a reformed accountant, because I've gone to a world of marrying financial issues and psychology, which is really behavioral economics, and understanding that, or appreciating that, the world isn't completely linear, that when you've got the mind at work, different things happen, but there is a framework for understanding it all. And how I got into this was, as I've reflected back on my career, I suppose there was a few steps. That when I was a CPA and I was a tax specialist and I had to deliver complex tax advice, often I was asked a question by one person, but there would be 5 other people reading the advice letters, and we were trying to charge $50,000 or $100,000 or more for it. You couldn't just write a one-line response or a one-page response, even though that's what some people would want and just needed to comprehend. There are others that needed much more than that, and you had to navigate that game. So I realized that I was really playing or dealing with human behavior, and how did I personalize the experience for each person? And I figured that out fairly early on, but it was intuitive at my guess, I suppose, at who the people were. And then when the day came that I was going to be finished with the world of being a CPA working in a big firm, I set up a wealth management family office type business. I was much clearer then that I wanted to provide a personalized experience that private banks couldn't offer, not only in terms of how the clients were dealt with, but the types of solutions that would get offered. And about 4 years into that journey, a friend of mine asked me, I think relatively innocently, but with a hope of helping me as well, Hugh, what are you really passionate about? And I said, I want to help people all over the world become financially self-empowered. And Lauren, I'd never said anything like that before, but I knew it was serious. If that came from my subconscious, that was really important to deal with. So I spent 6 months, 12 months reflecting on it. And what came up for me was that if I could understand a person's behavior, and particularly their financial behaviors, then I could solve 2 problems. I could solve the personalization problem that I was trying to deal with in the business in terms of delivering personalized solutions, but I could also help people deal with money better. And if I could understand how each person was wired to deal with money, then I could, educate them better. Because really, if you want to help people become financially self-empowered, it's about educating them about themselves. And those messages remain true today. And, the third layer on all of that is that money is what causes stress for people. Doesn't matter what the setting is, whether it's in your primary career, in making investments, in dealing with your family, how you shape up as a leader. Money, the energy of money is always there. So, and that's what causes stress. And today we've learned a lot more about stress in that it accelerates aging. So, but maybe because this is more of a financial show, we can keep off the health side of this. But other than to say health is wealth, but I think that if you said that was my pathway, and then I'm sitting there saying to one of my junior staff who was doing psychology and economics at university in Sydney, which was a rare thing in those days, and by chance I had her on my team doing more financial work. I said to her, go and spend the next 6 months researching all the systems out there and come back and tell me what we should build as a solution to deal with this to provide the clients. And I knew I didn't think risk profiles in the way in which they're built, including most of the way in which they're built today, would work. And it needed to be a different personality type tool, but not Myers-Briggs. That's got some limitations. And by that time, after 6 months to a year of playing around with all of that, I had a chance meeting with a psychologist who showed me that what I was really talking about was people's natural hardwired behavior. Under pressure, people show up a different way, and that's often emotionally, and that is how they make decisions. And I thought, okay, I need to know that if I'm going to build tailor-made plans for people for the long term, because I need to know what their stress response is going to be, not how they behave at a dinner party or in my office in a discovery meeting, who they really are. And I could see, over my journey, somewhat as a tax specialist, but also as a wealth manager in different situations, people did behave differently when they were under pressure. And that is all parties concerned. And, whether it's husband and wife and then children, business partners. So what was being brought to me was I needed to have a psychometric type system where I could scientifically measure who each person was, but make it a relatively friendly experience. Mm-hmm. And I needed to get to the financial behavior layer. And I got pointed to Atlanta, where there was a group of people that could help me build the system and get it scientifically validated at universities and all of that type of thing. So 40 trips and 4 years later, I end up living in America, and I've got a system, and I've made that my day business, being DNA behavior, and which started off with a product called Financial DNA, which is one half of what we have today. And that, that's the journey. And, I gave up the wealth management part. I probably, if I'd stayed in that, I'd be doing pretty similar to what you were doing. We had a high debt type fund, lending money. We did equity investments, and I was more interested in real estate type deals. I had an arrangement with a property developer where I'd help with the financial engineering. He'd look after all the construction and government planning. But at the end of the day, the pull to human behavior got too much for me. And couldn't do both. I couldn't live in America and then have that running along. Although, interestingly, 10 years or so later, I was doing that, running a community village, community living type village for retirees and varying other things. But again, it got too much. And so I've got to be singular. So that's a long entry maybe to the podcast, but it gives a story, I suppose, of brick by brick to some level of how I've done it. There's some leaps in there.
Right. That's great. So I'm very familiar with personality tests, having taken a number of those. And the way those generally work are, you take a test and then you get grouped into, whether it's, Myers-Briggs or Insights or whatever, you get grouped into this color or letter or whatever that says some certain things about your personality. And then, those are ranked, force ranked, and then that gives you an overall impression of who you are. How does your system, when it comes to financials, does it group people into similar like categories and then give an idea of kind of how they're going to react under certain situations, or how does that work?
So we have this, there's a couple of segments. So we do, like the systems you mentioned, measure how people are going to shape up in the workplace, what roles they should be in, how would they work in a team, and then we have the financial layer as well. So, but it's all coming from the same system. So there is a level of grouping which is done by those other players and us, in a sense, just to help simplify the behavioral understanding. But we actually, sitting under our system, have 4,000 different insights about people depending on what we're dealing with. But what if you talk about the financial layer, we are specifically identifying, for example, whether someone is a spender or a saver. How financially disciplined are they? We provide a specific measurement of that that's coming from a number of, it's the combination of a number of financial factors. We then look at someone's wealth creation motivation, because some people are very driven to create, a relatively high and, amount of wealth, and others are more content to be within a zone of where they are now and not sacrifice their lifestyle. There's risk taking. So we do look at whether someone's prepared to take risk and whether they can emotionally live with the consequences of taking risk. And so, which are two different things, because you could show somebody a property deal or an investment or a debt investment, and they will say, yeah, I'm going to do that. But when it doesn't deliver the returns, can they live with the consequences of that emotionally? There's another calculation, which is what I call financial capacity. Can they actually live with the consequences of the money not coming in or losing the money? That's a different calculation. But emotionally, some people will leap at opportunities, but can they live with the consequences of it? That's problematic when their preparedness to leap off the ledge, as it were, is much higher than their ability to live with it. Because some people just completely panic, as opposed to others look at it as, okay, there's pluses and minuses in life, and so long as I haven't been defrauded and there's no foul play, I'll accept the plus and minus. And that's a behavioral bias in its own right. Someone like me would tend to look at the consolidated view of it. What are the overall returns, rather than worrying about necessarily each one as such. So we look at then all those types of decision-making biases as well. So that's, in a sense, Lauren, where we're going deeper in the measurements. And then we're also look at what people's sentiment is in relation to the current economic market. So we have a tool sitting in there called Market Mood, which is linked to the equity markets, but it's giving you an idea of how people are feeling right now about their money and where the markets are. If the markets are looking, dangerous and going down, some people scared out of their brain, up comes the dial on red, and others are looking at, but other people in that same situation be saying, gee, that's an opportunity.
Yeah, those are the people that are selling their stock as it plummets, right? Versus the people that are looking at it as it's time to buy.
Correct. So in the financial measurements that we've got are looking at all those types of factors, right? And then, for example, who's going, and you've probably seen it, there's people who have leapt into one of your funds or projects, but then they've got some regret about it because they've either a little bit they've either put too much in for what they could really handle, or the return's slower than coming back, and they've got some regret about it. Whereas there's others that look at it and say, okay, I understood that. It didn't do the first time around what I expected, but I can see the track record and I'll keep going. There's others that are going to say, well, making 20% a year is not enough for me. It shouldn't be too many people saying that, but you know what I'm right. saying.
Do you see, so going back to the people with the gastrointestinal fortitude to take on that risk, is that something that in your research has shown that the people know that about themselves going into that, or they don't discover it until something bad happens or something good happens, and then they have to reevaluate?
Yeah, I think that events happening teach you how much you can take, because it's a bit like driving. Everybody would say that they're a better driver of a car than they really are. And I think it's well known in behavioral science that people would overestimate their ability to do something well than badly. Most people are not going to say that they are worse than they are. They're going to say they're better. So, and that also is an interesting point in the science of this, which is what I was trying to deal with when we built the system, was to overcome that kind of faking. Because if you say to somebody in X situation, how much risk would you take? And you have a series of questions like that, people are likely to overestimate how much risk they will take. Whereas what we got to was a forced choice scoring methodology that was very different, that didn't put people in situations that they had to rate or rank. It was more a forced choice between three words. Are you aspiring, detailed, or patient? Depending on how you answer and the combinations, we scientifically know who you are. And the idea of that is to remove that kind of situational bias. And that's something that's really important. And I saw that go on with tax, like you develop up the complex tax solutions, and there would be some risk taking that's got to be taken with tax, whether it's at an individual or corporate level. Everybody wanted to avoid tax, but not everybody wanted to live with the risk of a tax audit.
Is that directly related?
Sounds fine, right? But what people thought they could live with is a lot less than what they really could, what they were saying.
Yeah. Is that directly related to loss aversion? The idea that, people fear loss more than they celebrate gain.
Yeah. And loss aversion, and where I fit in the whole world of that with behavioral economics is that, Daniel Kahneman's work on loss aversion, where people, where the loss gain ratio is 2 times essentially, is that while loss aversion is true, it's not the same for every person. So his work is seminal in laying a foundation for loss aversion, of which then there are a number of other biases, in a way, if you want to call it that spring off that. But each person is different. I think that some people would look at the opportunity to make a gain versus a loss maybe at 1.5 times to the loss. Others, it might be 5 or 10 times. For the very lower risk people, it's different.
Meaning that they have to have the opportunity to win X more than what they lose in order to make it worth it. While someone else might be, I have the chance of losing 1, but I could gain 1.5. Or
yeah.
That's
and the more risk-taking type person would think of it that way. And if you're then someone like me is looking at, okay, what is the real loss? So in coming up with that calculation, what's the risk-adjusted loss is how I would look at it. And then what gain am I going to make against the risk-adjusted loss? But again, the work and the part I haven't talked about, Lauren, is communication. And so how is the product or the solution communicated so that somebody understands that within their paradigm? If I'm a very goal-driven person, I need to hear that message about what the real risks of the solution are versus the gains against my goals, whereas somebody else needs to hear it against their security, using different language. So if you think about it, you could offer the same debt investment in a fund like that you run in 4 different ways to get for people who with different learning styles and communication styles to understand it. And that would be helpful to also ensure that the wrong people don't get in it, that aren't, capable of doing it. Because you might only have a certain part of the population that's suitable for what you're trying to do. And that's not against the product in any way. That's just a reality that no product is perhaps 100%, or very few are suitable for every person in the same in the same degrees. But there might be people that, let's say that they're more loss averse, that do want to go in your product, but they might go in for a bit less, and it's in the overall context that they've got more capital to lose, as opposed to there's somebody else that wants to fill up their portfolio with something that's higher yielding, and they understand the risk involved.
And what we've seen, and I've heard other people see the same way, is some hedging on that. And so they'll come in with a certain amount of money initially and basically have this trial period, right? Which is usually 6 months to 9 months. And then we've seen a pretty consistent, like 2 to 3x increase in that second round of funding after the trial period has gone through and things have gone well. And so they're temporarily spreading their risk out, right?
And that's normally what I would advise most people anyway, is once you know the real risk profile, is then to build the person up. And then it's a matter of seeing, conversationally a little bit, how they act, the types of questions they ask, how comfortable they are. And, one of the early clients that I had when I was more a wealth manager space, guiding people directly every day, as opposed to today, I more provide the system to do this. But one of the earlier clients, this guy was about 40 years old. He'd made $10 million. This is 20 years ago, $10 million from a tech investment. He's 40 years old with a wife and 3 kids at home. And you could tell, I knew from his DNA style, from he completed the profile, that he was a risk taker and his wife was cautious. And he just came in and said, to me, Hugh, I don't want to take any, I don't want to take any risks. And so he got set up in a portfolio to start with that was pretty cautious. But every meeting, he'd ask, well, where are the returns? Well, he needed to be educated that returns come with taking risk. But within about 3 years, he was invested at 60% or so of the risk level that he probably should have been. It was just a guiding process. But every time he would ask, where are the returns? But then you'd show him diagrammatically, with graphs and things, what would happen if he lost some of the money and he didn't want to take it. But the risk, but also we had to balance out in there, his spouse.
That's got to be an interesting dynamic for you to look at and model. And when you have a spouse or partner set coming in, which one high risk and one's lower risk,
Yeah.
How do you factor that in when you're looking at their overall portfolio mix? Which way you go with that, knowing that there's usually kind of someone that's more in charge of money in a relationship and one that's maybe more driving things from a back seat.
Well, there's 2 settings that have to be addressed too for that question. One setting is the family wealth setting, and the other one is the business partnership setting. And how that might get handled is a little bit different. It may or may not be. But in the family setting, you do, I think one is that you do need to involve the wife or the spouse and understand where they're at, and with money and what their money history is, what their DNA profile is saying. You've got to look at the environmental circumstances. If there's goals there to send kids to private schools, how's that going to be handled? How do you keep the family in the home and keep it steady? If you're an entrepreneur like I am, how do you keep the family life steady and those needs being met versus chasing the dream, as it were? And that's really what the conversation then comes down to. What are the lines on that? And that, as I'm been helping somebody recently sort of as well, another business owner is around this, is how bought in is the spouse to your business? Because if they're not bought in and on the journey, that will always be, it's not a criticism of the spouse. It will always be difficult, right? Particularly if the money is not coming in like it used to, right? Or as expected. And so everybody's got to be on the same page. And that's really what the conversations are, but to get everybody on the same page and understanding where each person's financial DNA is, is a good starting point, then understanding some of the money histories, because you don't know where somebody's been in a family where their father or mother lost a lot of money and that's on their mind, or there's been a health event. And I'm not doing so, and I want to be careful to ensure this can be role reversed between male and female. It's not centric to one or the other. Women can take more risks than men. They tend not to be on the overall as bigger risk takers, or a little more considered with it. But in some family dynamics, the man might be the breadwinner, but the female is a bigger risk taker. That can happen, and it can be the other way around. There's so many settings for this, but it's getting everybody to have the conversation. And I think then in the business, sorry.
Yeah, I definitely could see that. I mean, I'm far more much more risk taker than my wife is, who's much more conservative. But having said that, if with my wife being around, I'm more conservative than I would be if I was on my own, right? And so, and I believe she comes more risk taking because of me, and so we both kind of come more towards the middle than we would on our own.
Yeah, yeah. I think that's right. And then you've got the business scenario. Let's say you take business partners, and you've got one that is the visionary and can see the future and is very competitive and determined to achieve the 10x goal, or the 10 building goal, or whatever it is. And then you've got one there that's more operationally minded, more conservative, and he or she might have been fine with the start of the journey, but now we've made, like in the case that I dealt with, a number of years ago, the business had got to about 10 million in revenue and everybody was happy. But to go to the next stage, it needed to take on debt and other types of sort of what I call higher risk facilities involving personal guarantees and whatnot. And one of the partners said no. And that was in part him. He was cautious, but it was also his wife, right? Was in the mix there. And then you've got the other one that's all gung-ho to go. And so you've got to deal with that. And does somebody have to exit the business, or do you have to restructure it so that one person's got control? Because I think that's also, if you're going to take more of the risk and take on the debt, you probably got to have control to make decisions. But they're conversation points, and this is what can stop a business growing. It can become a wedge between partners if not communicated. But everyone's got to understand that at the end of the day, if you want to make more, you're going to have to take more risk. And it doesn't matter what that business is, whether it's money lending, somewhat like what you're doing, being the real estate developer, being in software technology. That's just the fact of life.
Yep.
How do you minimize the risks? That's probably the point. And what governance are you putting around it? That's probably the bigger point. And Lauren,
and how do you balance that? Because you can de-risk the heck out of everything, but then you operationally just can't make the thing work because it takes so long to make anything run when you've de-risked it so far.
Yeah. So that becomes a point there where it's a structural decision. And the other area that I see with all of these things is that with let's say with business owners, but I think it can still be the same with executives and sort of the family wealth management. If there's a very high personal spending level, that will also, or be what I call a lot of wastage in the business as well, that will also be a problem. And we see it in a lot of companies. A lot of money is wasted on innovation, going down rabbit holes, art on the wall, people flying on private jets, first class, lavish entertainment, because they think that's what I should be doing. But is it actually producing anything? Most of the time it's not. But that can be a drain on the business and stop it growing. So that's why I'm very big on in using the financial DNA and sort of this inside out approach, if you want to call it, to understanding spending is a very big part, whether it's for personal wealth creation or whether it's what's being done in the business, the fiscal control in the business.
Makes sense. Can you give me, so let's talk maybe hypothetically a little bit here. I've got two people. They're both 65. One has done extremely well, very successful in business, entrepreneur. Another one, maybe not quite as successful, significant reduction in overall assets, at the same age. What are some of the key pieces from a personality standpoint that might have contributed to that vast difference in overall net worth at the same age?
Well, I suppose I'll do my best with that because that's actually a pretty interesting question. So, I can tell from your smile, you knew what you were asking. But if you took the person that perhaps has not made as much at 65, it could have been because he was ultra cautious. And we're talking about the levels of wealth there are also probably relevant. But he could have been ultra cautious and didn't take opportunities when they arose and didn't was so blinded by caution and analysis and didn't go with actually something that would have been a great opportunity. And I think at the end of the day, my philosophy is that probably by the time you have reached 65, we've all had situations where there has been a great opportunity turned up. For most people, that's been true. I do know situations where someone hits 65 and a great opportunity turns up. This is their chance. And they decide, I'm not going to take it because, well, in their mindset, they're too old, or this is too good to be true, or whatever. The skepticism gets ahead of themselves, or they haven't got the energy to do it. But, there's no right time for everybody. But keeping to the rational side, somebody hasn't taken the opportunities, or they've been such a risk taker that they've taken too many of the wrong opportunities and splattered it up against the wall, and therefore they're not at the same place as somebody else. And that can happen to, people that are in the entrepreneurial world. It can happen. I've seen it happen to airline pilots that been making a pretty good income, but think that they can go and do property developments too, and they can't, right? That's just a simple reality. Some can. I mean, I know others. There's a Delta pilot that I met 20 years ago that's got a great, 15-story apartment. But you also don't know how he got to having that, right? In terms of building relationships, family capital, the wife, whatever. So that's why we've always got to be careful about how we judge and assess these situations, because one person might have had a lot of capital and have got the smarts on what to do with it, and took opportunities that came from having the capital or having built a relationship network. Because I think that the person that's probably got more out of in the scenario you talked about has perhaps had a better relationship network through which they've taken advantage of opportunities and probably had a better mindset to it. And so if you said they were both the same on risk taking, the relationship network might be the difference there. It can be what's the intellectual capability or the cognitive capability to assess deals can be different too. And so, people lose money by getting into things they don't understand and with people that they haven't checked out properly. That's a factor. And I think also it's a weighting, how much do you put into one thing versus having a spread? You look at the Madoff situation all those years ago, 15 years ago, and how many people put all of their money in that, basically out of greed and not checking out what was going on. Now, of course, there was fraud involved, and it's very hard to know when fraud's happening, right? When it's concealed like that. But I think you can see where I'm going, that there's probably many forces at work why two 65-year-olds might have a different level of money. I would say as business owners as well, some get it right earlier, others it takes longer for it to come to fruition, and in the middle of there, some bail out too early.
Yeah. So my not nearly as experienced as you, right? But my sight on things from where I've seen with investors and with people that I know is there seems to be two things that I always notice is A, they take action, right? They see an opportunity and they know to take it, and they don't, him and haw on it forever and miss it. And the other thing is when things go bad, because something always goes bad for someone at some point, they consistently take the correct actions afterwards. They don't quit.
They
And
write it
so
off. They will either deal with it properly, right, and go in there. Let's take it. It's a real estate deal. If it goes wrong, the more rational, hardline investor will go in there and sort out what needs to be sorted out, whether it's dealing with people, governments, finance, banks, and whatnot. And if there needs to be a write-off, they'll take it. Whereas others will run 2 miles from all that conflict and just leave it sitting there potentially, or not deal with it, depending on who's
right.
what the type of deal is and who's wearing it, and that's probably what you're saying. And I think that's what I was also trying to say at the start, that the risk taker that's calculated and experienced will probably know what's a good opportunity and not a good opportunity, and got some kind of network as well. Like he or she is with the right people and they just do it. Whereas others are still sorting all of that out in some way, or haven't done the work to sort it all out. Because I think that's, Lauren, a point that I would make with investors is investing does require some work. And, if you want to be completely passive with investing, then go and buy ETFs, right? And a pool of REITs and leave it alone, right? But anything beyond that requires some work. And if you want to make returns above market, that requires work expertise. That's just a fact. I don't think there's a free lunch in the world around that. And that's a problem for a lot of investors. Go to dinner parties, people go to dinner parties and they hear somebody else making money. Well, I want to do that too. And they jump into something that's very ill considered.
Mm-hmm. Yeah. See it all the time. People that have lots of money, number one thing they look for is how do I make more money? And number two thing is how do I save money on taxes, right? You mentioned a little bit about the risk, and with 65, we touched on a little bit, but talk to me about how age plays into both risk taking and spending tendencies.
Yeah. So on the, what we say is at the first level of behavior, you can call it level one, or Daniel Kahneman, we've always called it level one, but Daniel Kahneman came in and referred to it as system one. And I belabored that point because somebody mentioned that to me before recently. I said, well, we were defining this in levels before Kahneman actually did that. That's sort of Hugh and behavioral economics. But I think the point being is, if instinctively in your DNA behavior, at your natural hardwired behavior level, that you are a risk taker, you're always a risk taker. So I'm one of those who's a risk taker. I will always think about everything that comes before me from a risk-taking lens. But as you age, and depending on where your financial goals are and what you're seeking to do in life, you may taper consciously. So this is the level 2 behavior, or the system 2 behavior. You may consciously say, I'm not going to take those risks because I don't need to, or it's not appropriate. But that's a conscious decision. So there's unconscious thinking and there's conscious thinking. The unconscious thinking is always with you. Very few people can change their unconscious thinking.
Do you think that's data driven as you age, or fear driven, or motion driven?
As you age, it could be both. It could be data for the more aware. And then for others who'll just say, okay, I'm 65 or whatever it is, I'm not going to do it, right? That's just a straight out emotional decision. But in a way, it may not be very rational either to do that. But I think what I'm trying to bring out is that everyone says, well, risk taking just goes down as you get older. It's not entirely true. There are people out there who will keep taking risks of some sort all their life because that's the way they're wired, and that was there all the way along. But they might get better at it from wisdom, education, sizing up situations, and they won't take a risk, and there might be, some will take a hard left turn and go away from it in markets, but that's probably experience at work. So I'm trying to bring up, I suppose, the point of that there is unconscious thinking and there's conscious thinking. And the same will be, spending's a different one, but the same thing that there are some people that are inherently always spenders. That's what they do in life. They're extremely generous. They like to travel first class, etc., etc., and it is hard to stop that. But some people, out of necessity, because they haven't got the financial resources, will have to slow it down. And a budget become part of life. But I know people that have got plenty of money. Let's say more than $10 million, right? That's a lot of money, really, and they're tight-fisted with it. In not only in business and in how they invest, but for their personal life, that doesn't change, right? It's hard to and that might be for some of them. You can say, okay, they were brought up in the Depression or they've seen a darker day, but there are some that are just who didn't experience that. It's just the way they are.
Mm-hmm. I mean, look at Warren Buffett. He's still living in the same house. He's got like $373 billion in the bank, right?
Right.
Same house.
That's right. And so, it just comes down to values, to belief sets, with all of those things. So, I think that's how one has got to size it up. But if I see people out there that are high on risk taking, but also big spenders, that's when I get concerned. Because they're normally going to be emotional people, normally not. They're going to jump into stuff. They're going to jump out of stuff, and they're always juggling the ball, and there's no structure. And that's one big warning. And the other would be the complete other side, that they don't take any risk and they're just hoarding money. They're probably going to be very awkward to deal with, and that may not be your client either. Because they're too linear and they can't deal with a bump in the road. And I was dealing with someone recently who's like that, and I just realized, you just start to realize there's no flexibility.
Yeah. Yeah, and I've run into people like that, and I've run into people the other side of that, and we just say thank you, and we don't think you're a good fit for what we're trying to do, right? And that's fine. There's nothing wrong with that. It just doesn't fit for what our culture is.
Yeah, and I think as essentially, Lauren, as a fund manager, I think you, like a wealth manager or even any professional, you've got to look at and say, who's my ideal client or the ideal investor I want, and you want to know enough about them to make that decision as to who's ideal, and probably not let anybody invest too much in the first go around and see how they behave, right? Because I think, back to what we said earlier, you're going to see the truth when something goes wrong as to how someone's going to be. And and a lot of those reactions come down to how things are communicated, either from their side or your side. Communication becomes very important.
Yeah, 100%. So we're getting close on time. I don't want to take a ton of your time. So the question I always ask everybody at the end of every podcast is, if you knew everything that you knew right now when you were 18, or everything you know right now when your kids turned 18, what advice would you give them based on your current knowledge set?
Yeah, well, I think that's wasn't quite the question I thought you were going to ask me, but it was half of it. I would always say to dream big, and then start small and finish big, and that no one should lose their dream. Everybody should find what they're passionate about and find a way to go and do it, even if it's not as a full-time job, but it's built into your life in some way. I think that's really important. If you can find, your dream and something you're passionate about and go and do it in your work or building a business, that's fantastic. But never lose sight of any of those. But don't go and ruin your life journey by trying to make it too big on something too quickly. And I think that plays to your brick by brick philosophy. And at some point, though, maybe if you've, depending on the business you're in, if you get the formulas right, there will be chances where you will make a supernormal return because you've got every piece right. But that's not going to happen all the time, you know. And just because it then happens one year, don't think it's going to happen the next year. But if you're in there doing it properly and taking opportunities, luck can come your way. I think that there is always an element of luck, but you've got to be in the game for luck to come your way. And in a way, that's making your own luck.
So, Hugh, if any of the listeners want to reach out and learn about DNA behavior or learn about your book or learn anything about you, where can they find you?
The best place to find out everything that I've probably ever said or done predominantly is on our website at dnabehavior.com. There's a lot of resources there, but also in my LinkedIn account, Hugh Massie, and I'm in Atlanta, so pretty easy to find, and you'll see a massive stuff there.
Awesome. And who's your perfect customer that you would love to go and visit your stuff today?
Yeah, I think my perfect customer would be, to be honest, someone in their 30s or 40s that's been around the traps a little bit and had some wins and losses, and now really wants to set their path for building their future, whether it's in building a business, they want to go on a growth path and build something. But I'm okay with somebody as well that's a leader that wants to grow and be entrepreneurial with it, to innovate, to help them. Or if you are an investor, to help you see, pathways to grow, through understanding people. Anybody that's interested in that, then that's good for me.
Awesome. Thank you so much for your time. I will make sure that all of your links will be in the show notes when this goes up. So if anybody wants to learn about Hugh or DNA behavior, please reach out to them. He has a wealth of knowledge. And until next week, thanks everybody. Have a great time. Thanks for tuning in to Brick by Brick Wealth Building Conversations. If you enjoyed today's episode, don't forget to subscribe and leave a review. It helps more people find the show. For more tips, resources, and updates on my journey, follow me on Invest with Lauren. Let's keep building wealth, one brick at a time. See you next week.